Hey guys, what's up? I'm Erin and welcome back to the channel. When it comes to what we want to get out of our investments, I feel like the default answer for most people is a good performance. We want to capture a good return. We want our money to grow. And when it comes to traditional investing, these are the things we focus on: profitability, the growth potential of a company, and market share. The goal of a traditional investment is quite simple. It is to maximize financial returns. And for the vast majority of history, and still presently today, this has been the predominant style of investing. But recently, there's another style of investing that's gaining popularity, and that is called ESG investing. And rather than solely focusing on the financials of a company, it allows you to consider companies that have a good environmental impact, good social stance, and corporate governance issues. You may also hear this labeled as socially responsible investing or sustainable investing. Basically, companies that fall into this category have to meet standards that go above and beyond financial metrics. You're not just looking at a company's profitability, you're looking at their overall impact. This calls into question morality and doing the right thing. On the environmental front, this would look at a company's dedication to protecting the natural environment. Maybe that's through reducing air emissions, energy conservation, resource usage, and disposal of materials. On the social front, it's considering relationships, how employees, clients, and suppliers are treated, and the involvement of the overall community. I feel like this one touches on the golden rule. It would be a company that treats others how they want to be treated. From the perspective of corporate governance, it's looking at how ethical a business is. Is there a trusted level of transparency? How are the pay structures handled within the company? And ESG investing has gained quite a bit of traction in the past handful of years. Investment dollars in sustainable investment funds has tripled in the past decade. And it makes sense as to why, as we become a more socially conscious culture, it only makes sense that we would want to invest in companies that are holding themselves to a standard as well. All major brokerage houses these days offer sustainable fund investment options. And if you're so inclined and you choose individual investments, you're welcome to research individual companies to make sure that they meet your personal standards as well. By considering non-financial factors, ESG investors believe they can better assess a company's risk profile, including exposure to regulatory, reputational, and operational risk related to ESG issues. Maybe these companies are less likely to find themselves in hot water or intense litigation because they hold themselves to a higher standard. Essentially, it's trying to support companies and invest in companies that more or less align with your personal values. So is ESG investing better? A lot of times when we call into question morality and doing the right thing, we can have this knee-jerk reaction, which is, of course I want to direct my dollars to a company that's trying to reduce its emissions because I care about having a healthy climate. Yes, I want to invest in a company that treats their employees well and values diversity and all of those things. Unfortunately, it's not a simple question of does it feel better. When it comes to measuring performance, we have to use some metric. We have to use some standard to assess whether it truly is better. First and foremost, we have to consider performance. Quite simply, from the stance of investing, we have the goal of growing our wealth over time to the point where we reach financial independence and we're no longer reliant on a paycheck. It takes time to get there, but that's the ultimate goal. And so the question we have to ask ourselves is, does ESG investing allow us to do this, or does it allow us to do it better? When it comes to socially responsible investing, funds that meet this criteria are always going to be actively managed. There is going to be someone at the helm making sure that the companies that get selected for this fund meet a specific criteria. And when you have actively managed funds, those type of funds are always going to have higher expense ratios. Now, being that these type of funds are also available through low-cost brokerage houses, think the Vanguards of the world, Fidelity, BlackRock, it does mean that a lot of these funds do have really low expense ratios still. For instance, the Vanguard FTSE Social Index Fund has an expense ratio of 0.14%. To be sure, that is a phenomenal expense ratio. But compare that to the Vanguard Total Stock Market Index Fund, where the expense ratio is 0.04%. Again, I want to reiterate that both of these funds do have an amazing expense ratio, even the actively managed fund given in this example. But it is just worth keeping in mind that actively managed funds will always have a higher expense ratio than passively managed index funds. If we compare the Vanguard Total Stock Market Fund to the Vanguard FTSE Social Index Fund, we can see that on a 5-year average that the social index fund has actually outperformed the total stock market fund by nearly 1%. And we see the same exact thing when we look at the Fidelity Total Stock Market Index Fund and the Fidelity US Sustainability Index Fund. On a 5-year basis, this sustainability fund has surpassed the performance of the total stock market fund by over 1%. I'm going to be really honest here. I was actually really surprised by this outcome. I truly thought that the total stock market funds would have surpassed the performance of the sustainability funds, because I feel like when you're doing sustainable investing, you kind of limit yourself in your choices. You invest with handcuffs on, so to speak, because there's certain companies you simply can't invest in because of their practices. And granted, we have to consider that this is only a 5-year performance. In terms of investing, 5 years is a very short time horizon, so these funds are still very young. But it's worth keeping an eye on these funds and seeing how their performance plays out in the long term, because I'm definitely the person who would say that a 1% difference, even after the higher expense ratio, makes a huge difference in the long run. If you invest $500 a month over the course of an entire investing career, say 45 years, if you can capture a 9% rate of return versus, say, an 8% rate of return, you can end up with nearly $1 million more in your portfolio. Now, I do know that the funds we used in the example actually had 14 and 15% rate of returns over the past 5 years, but keep in mind we've had some stellar years in the recent past, so there's no way I'm going to type in a 14 or a 15% rate of return, projecting that over the next 40 or 50 years for an entire investing lifetime. There's bound to be a reversion to the mean. Rates of return absolutely matter, because if you invest the exact same amount, if you can capture just an ever so slightly higher rate of return over the long haul, you can end up with vastly more. It's also worth considering the limitations of socially responsible investing, because to truly engage in socially responsible investing, you have to be sure that all of the companies that you invest in meet your standards. But it's not just the companies you invest in. It goes beyond that. You have to be sure that all of the companies that they interact with and their suppliers meet your standard as well. And that's no easy task. Perhaps you're familiar with the chocolate company Tony Chocolonely. They have set out to be an ethically responsible company. The big problem in the chocolate industry is that as manufacturers and suppliers attempt to force prices to be as low as possible, the actual farmers of the cacao bean are forced to live in poverty, and illegal child labor is utilized to harvest these beans. Therein lies a huge ethical and moral problem. The goal of Tony Chocolonely is to only deal with suppliers who do not utilize any child labor, which is actually a very unique position to take in the chocolate industry. Well, in 2021, Tony Chocolonely was removed from the slave-free chocolate list, not because of their actions, but because one of their producers had been found to have violated this criteria. This is exactly what I mean by limitations. You can do everything you possibly can to make sure the company you invest in is held to a certain standard, but it's very hard to make sure that every company that they interact with is held to that same standard as well. Because let's say you only want to invest in a company that meets certain emission standards. How would you feel if you find out that that company is working with a supplier who fails to meet those certain emission standards? Are they still a company worth investing in? And actually, I don't have an answer for this question. It's really meant to provoke thought. I think the idea of sustainable investing is a good one, but I think it's important to keep in mind that it inherently comes with some restrictions. And it's also worth keeping in mind what we ourselves as individual investors are capable of. We can vote with our dollars as consumers or as investors by where we're willing to direct these dollars, but ultimately trying to solve macroeconomic issues on a micro level isn't wholly effective. I love drinking bubbly water, and a socially responsible thing to do with this can is to recycle it. And if I and my entire community do that, we can have a small impact. But if you really want to have a broader impact, something has to happen at the macro level. For example, the company would have to decide to make this can out of a more sustainable material. If you can impact it on the macro level, that's going to have a bigger impact than all the individuals attempting to recycle it. Addressing social issues, environmental issues, and corporate governance at the corporate level from the top is going to have far more of an impact than what we can do by directing our investing dollars to specific funds. I think the idea of investing in socially responsible or sustainable companies is really great in theory, but really hard in execution, because ultimately it's really hard to know how the companies they're interacting with are behaving. You also have to consider that there's so many different intermediaries when you're investing. Maybe you invest in your company's 401k. Well, your funds that go into your 401k collectively get pooled at a brokerage house. It's the brokerage house that then directs these funds to a management team, and it's the management team that is individually vetting these companies to make sure that they are sustainable. Are they meeting the standards that you're setting out to meet? So I think it's a really good theory, but I think it's hard in execution. If it makes you feel better to only invest in companies that are behaving in a socially responsible manner, I think that can be a great move. But I don't think there's enough data at this point to have me go all in on socially responsible investing, simply because I think it's a very nuanced subject with very little regulation. What are your thoughts on sustainable investing? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.